Hey everybody, what's up? Today I'm going to be going over what I think the market will be doing in the next couple weeks and months following the rate cuts that will happen, as well as just going over where my portfolio is, the moves I am currently making, and the ways I am planning on trading in the next couple months with the new rate cut environment that is happening. So if you're interested, make sure to subscribe and let's get into it. So, if you watched my last video, which I highly recommend as it is another one of my videos, um, I am a little bit higher than I was just a couple days ago when I recorded that. I'm at 52.7% for the year, which is why if you have not followed my channel before, you should be subscribed and watching because these returns are just about 40% higher than what the market has returned so far this year, which in my opinion is fantastic. And what we are looking at is 41.5 at the moment. Some moves I made over the past however many days it was Chewy and IT or Gartner are no longer in the portfolio. I sold them off. Not so much because of lack of performance, but more I was positive comfortably on both of them, and I want to build up a larger cash position for this next part that I'll be talking about. So currently at just under 6,500 in cash, along with 6,000 in bonds that will be turned into cash shortly because Vanguard doesn't support under $10,000 bonds anymore. But that's a whole nother story. But anyway, let's get into it. So first of all, I'm just going to be looking at SPY today to do my talking. And what I'm really looking for, if I'm being completely honest, is something along, let me see where I want to put this, these lines here, 10 to 15% drop over the next couple months. The reason it is that width, is because it is the same width as the inflation drop that we saw back in 2022 and 2021. Will it exactly do those things? Probably not, but there are a couple things that I am looking for here. So, one, inflation is not great. And while it seems like it's pretty good, I think there is a lot of downward pressure at the moment due to the current interest rate situation. Now, if you know what the future interest rate situation is going to be, you know they're going to be cutting tomorrow. Today is September 16th. Tomorrow they will be doing rate cuts. If it's more than 0.25%, this could be amplified or uh, it could come faster. But what I'm looking at and what I'm thinking, which again, I am not a 100% expert, I just have opinions on this. I'm thinking that there's a lot of downwards pressure on inflation due to high interest rates. Once they start cutting that, the inflation that everyone was expecting to happen with tariffs is most likely going to start hitting a lot harder. Um, that, alongside the already very weak and rapidly weakening job market, combined will probably cause the market to drop significantly. A lot of people say that the correlation between rate cuts and the market dropping is not heavily supported most of the time. But the argument against that is that it is the factors that cause the rate cuts that cause the market to drop. So if you go onto Google right now and search up rate cut correlation with stock market dropping, you will see that almost every time they start cutting rates, the stock market begins to drop. And that has happened every single time for the past 30 years, almost every time. Don't quote me on the entire thing, but most of the time. And it's almost always because of the reasons for the rate cuts. So, not the rate cuts themselves, but high inflation, poor job market. These things cause that to happen. So, the job market, the numbers keep getting revised down more and more severely. And the problem with that is that, in my opinion, the job market, especially the numbers, are almost always going to be behind. So, we are seeing pretty heavy damage now, and the rates have been too high for way longer than the numbers we're seeing, if that makes sense. So we are too little too late, in my opinion. And what's going to happen is we're going to see worse and worse numbers, possibly rising unemployment. Again, putting more pressure on cutting rates even more to hopefully boost growth in the job market. The problem is that inflation is not specifically at our target rate right now, which is not great. And the only thing keeping that down from what I'm seeing is the interest rates. So they're going to cut it, inflation is going to rise, job market is already suffering, and because we're already behind, the job market will continue to suffer while inflation rises, hence market dropping. So that's what I'm seeing. This is kind of the pattern I am looking for, something in this range. Not saying that will happen, just my own personal opinion and prediction. So tell me what you think in the comments. If you disagree with me, let me know and really tell me why, because I'm always interested. And that is about it. Here's the long-term general support area we're seeing at this nice big long line. And I think that's about it. So thanks for watching. Let me know what you think. Make sure to subscribe. And that's about it. See you next time.